in a period of time, I lost about $1 million from a few investment mistakes. There's three that come to mind. So one was I bought a section in the Marlborough Sounds. What on earth I was going to do with that, I have no idea. And I sold it for about half what I paid for it.
Wow.
12 years later.
Wow. Welcome to the Lowe Down. I'm here with Adam Cockburn, who is a former chair of the Wellington Property Investors Association and also a long-time property investor. And today I'm going to ask Adam what his biggest investment mistake was, and we're gonna try and learn from your.
You want me to air my dirty laundry?
That's right. We're trying to try and learn from what you've done wrong.
Firstly, I was the chairperson of the Wellington Property Investor Association for about 5 minutes.
Right.
But I have been on the committee for about 20 years.
Good.
So good organisation too. Anyone who wants advice on investment and so on. But my worst investment mistakes. I would say I haven't done these calculations accurately, but I would say. In a period of time, I lost about $1 million from a few investment mistakes. There's three that come to mind, and interestingly, they all came about when I made decisions to purchase assets at the very top of the last cycle in about 2007. But they were even, despite the market timing of it, they were all poor decisions, terrible decisions. So one was I bought a section in the Marlborough Sounds. What on earth I was going to do with that, I have no idea. And I sold it for about half what I paid for it.
Wow.
12 years later.
Wow, that's incredible.
I bought a couple of serviced apartment units in a hotel complex in Nelson, and I owned those for about 12 years. And I earned a precisely zero income, not net income, gross income, no revenue from those assets whatsoever, a bit like the section, for 12 years or so. And again, I sold them back to the developer after 12 years. And then thirdly, I bought with a couple of business partners, we bought a large vacant lot in Levin, and we built some storage sheds. And then the market just crashed and nobody wanted storage sheds. So they sat largely empty for years and years and years. And again, we ended up selling that for, it would be probably less than half price what we paid for it, plus the development costs. Yeah. So I don't know how much that all adds up to, but it was a lot of money, very, very painful. Once I got out of them, even though I sold them for half, roughly all of them, about half what I paid for them, 10, 12 years later, it was such a relief because it was that monthly cash flow, just like a hit every single month, just like dealing with that year after year.
And all three of those at the same time.
Yeah. Because we bought them all at roughly the end of the last boom. And this is one of the main lessons from it really is when the market is crazy, people tend to make crazy mistakes and crazy decisions. I was in desperation searching for yield. In the end, there was no yield. That's the irony of it.
Yeah.
There was no yield. And the reason I got it so badly wrong was fundamentally because I bought things that I really didn't understand.
Yeah.
And so that was the biggest mistake.
Yeah. So focus. I mean, you need to focus on cash flow, obviously.
Cash flow, the number one, the number two, and the number three priority.
Yeah. And then secondly, you got to understand what you're buying, and that's true of all assets, right? Doesn't matter whether it's property, everything. You really, and people fool themselves about what they do understand.
So what does it mean when to say? What do you mean by that when you say you should buy something that you understand?
Well, I think a good example of that would be, if you look at the hotel, if you say you got zero gross income,
yes,
right? Expand on that because it's interesting, right? Like how is it possible to get zero gross income off it?
Yeah,
it means it must have just been unrented the whole time.
You buy the units off the developer, and then there's a management company that runs the hotel, and the owners of the assets take a profit share in the hotel operations.
Yeah.
If the hotel makes no profit,
you get nothing. Yeah.
Correct.
And so and did you get legal advice, or what was the reason you didn't have a deep understanding of that risk?
Well, the main reason I didn't have a deep understanding of it is because I had no idea.
Yeah.
I was just being a brainless, unwise investor thing. I mean, the whole, we've talked about this before, but when you're at the top of the market, it doesn't matter what you buy. People are making money. And so there's this enormous fear of missing out. There's no stories of anyone losing money. You just don't think it's possible. So at the peak of the market, at the peak of the fervor, everyone believes there's no risk. That's when risk is highest.
Of course. I mean, there is a parrot to your point about, how do you what does it mean to really truly understand an investment? There's sort of an interesting paradox, isn't there? That, in life we learn through feedback loops.
Yep.
And it's also hard to know what you don't know, right?
That's right.
So it's a real skill to be self-aware enough to know where your blind spots might be, what you truly don't understand. And especially when we learn typically on the job, like we learn through the feedback loops of life, that paradox of sort of really needing the wisdom to understand what you don't know.
Yep.
And needing to put the energy and effort into learning until you really are at the point where you can have the courage of your convictions to buy something safely. That's actually probably what actually differentiates the quality, high quality, skilled active investor versus the average person who should probably buy index funds and actually take low risk, have high diversification, not be too concentrated. And it's actually that probably separates those two. Would you agree?
Well, I think humility is and it's extremely
pretty humbling.
Yes,
pretty humbling having that happen.
Massively humbling, but to always just remember, nobody knows very much.
Exactly, totally.
Yeah. And so coming back to the original thing we were talking about, which is what does it mean to say you need to understand what it is you're buying? I believe the thing you need to understand the most is risk. There's always risk, and the more you can understand those risks, the better. I mean, if you can protect the downside, the upside will take care of itself.
Play defense, not offense. I always say I think that's a really important insight in life, is to play defense, not offense.
Yeah, and we're all guilty, aren't we, from time to time, especially competent, intelligent, successful people. We can all be guilty of really becoming arrogant and suffering from a healthy dose of hubris.
Well, the worst thing happens to people when they've had a few wins. And had the feedback loop that they can just...
And they think they're invincible.
Yeah, exactly. Yeah.
Just got to remember, got to be humble. Stay humble. Humility is awfully, is very useful in this game. And just remember, look, none of us know everything, and none of us know very much at all, in fact. But the more you can understand the risks and protect the downside, the better. Easier said than done.
So what on earth were you thinking with the section? Tell me about that. It's fascinating.
Honestly, it's mental. I don't know. I mean, at the time, I remember they'd been given a resource consent for a marina, and I thought, oh wow, once they've got that resource consent, that will really increase the excitement around the whole project. The fact that there was something like 300 sections there in an area with, I don't know, 30 sections sell a year. I mean, you've got 10 years worth of supply right there. How can price possibly go up when you've got that sort of balance of supply and demand? But like I say, look, at the end of a cycle, look at the US share market now. No one can do any wrong, apparently. It just keeps going up and up and up in the face of all sorts of things going on in the economy and risks and so on, right? So right now, very few people investing in the US share market think that there's any risk. Well, right now is probably the time when the risks are highest. Same with back then, 2007. We'd had this massive bull run from 2002 to 2007. Everyone was making money hand over fist. Money was easy to get. And so, just... you could buy anything and you would have made money. But then, of course, when it changes very slowly and then all at once. And so, I just became unstuck and boy, painful lessons. And of course, looking back now, the amount of money involved, it seems a lot smaller. But of course, back then, 18 years ago, that was a lot of money. A lot of money back then for me. Yeah.
And really, would have slowed things down for you in terms of, what you could do.
Oh, 100%. I just had to focus on throwing cash into the fire every month. I just had to have enough to feed the flames.
And I'm guessing, because we talked about this in the last podcast, is that with that cash out going and the leverage you obviously had into those, when things suddenly were cheaper, and you had this.
Imagine what you can do if you had the ability to buy something when the buying was that good.
You were all tied up, right? Hence what we talk when we say, and this is really what we mean when we say you play defense, not offense, right?
Yep.
Is if you keep your leverage and your gearing within reasonable means, and you keep your cash flow high, which was to your original point, then of course you play a counter-cyclical game and you lever up a little bit more when times are really bad out there and things are cheaper, where ironically, of course, risk is lower, but it feels higher.
Yep.
That's the time to take a little bit more leverage on, but not too much, right?
And that's also the time when it's hardest to borrow the money because the banks are very nervous too.
But you can borrow it when your levering is not
as
too
long
high.
as long as your position is sufficiently liquid, and you have that headroom in terms of your debt capacity. And
I mean, there's
so
always, it's interesting, right? Because there's always someone out there you can see or pinpoint that has made astronomical gains in life by taking huge bets. Mm-hmm. So it's just
yes.
And so you
so it's very tempting.
It's very tempting, right? You can see, you look at someone and you can have, spent their whole lifetime being recidivist borrowers and have used that to end up on the rich list or something like that. You look at that and think, well, that might be a strategy that might work for me, right?
Yeah. But the landscape's also littered with corpses.
That's what you don't see, right?
That's right. So, I mean, you talked before about being in this wonderful position when the market does tank and there are no buyers on sites and assets are going begging at these crazy cheap prices. It's amazing to be able to move on some of them and gobble some of them up, right? And then you'll benefit from it tremendously. Well, if you can't do that, the next best thing is to make sure that you are at least still standing when the end of the trough comes so that you can then benefit from the next upswing, right? If you're going to make a bunch of money from investment over a long period of time, say 50, 60 years, the number one objective is don't go under.
Yeah, that's right. Yeah.
Right?
Was it Warren Buffett was the number one rule was never lose money? Or was it Charlie Munger?
Never lose your capital.
Yeah.
Rule number 2, refer to rule number 1. Right? So if you get wiped out once in a course of 50 years, that obviously has a huge impact on where you end up. Right? So if you can just make sure you don't get wiped out, so that means you can survive the deepest of troughs, because getting wiped out happens in an instant, in a day, in a month. It's not, and so often I hear people talking about, but on average, this is what the returns are. On average, this is what the interest rates are. You don't have to survive the average day. You have to survive every day.
Yeah, that's
and
true.
the longer you're in the game for, the higher the chances are that you are going to have to survive the worst day in history or a very, very bad day in history. So, it's a bit like the story of the 5-foot man who drowned a 6-foot man who drowned crossing a river that was 5 foot deep on average.
Yeah, that's right.
You have to be able to survive the deepest of all troughs. And so taking that conservative view and making sure that you are at least standing at the end of the downturn is survival is the first objective.
And the other thing about this is people underestimate what compounding will do over time and to how incredible their lifestyle can be changed in just a couple of decades. From being conservative, like you don't need to shoot the lights out.
No. You don't have to be a billionaire.
That's right. And in fact, there's diminishing returns with wealth. The big returns early in terms of lifestyle change, but at some point, it's like, who cares, right? It's not really going to make any difference whether you have 5 beds or 4, or you've got 2 houses or 1. It's not really going to change your lifestyle that much.
So we've agreed that being playing with a straight bat or being conservative, protecting from the downside is right up there in terms of priorities if you're going to be a property investor. So how do you do that? How do you protect the downside? How do you be a conservative property investor in your opinion?
Have more equity. To invest,
borrow less,
and you wait until you grow your equity first before going and levering up again and buying another property first and foremost. I think that's important. Focus on cash flow, which is to your original. Maybe that should have been point 1 actually. Is focus on cash flow and with cash flow, I think there are hidden costs. So you have to deeply understand that let's just say use a body corporate for an example, like an apartment. If you buy a brand new apartment with a $5,000 body corporate fee, is that body corporate fee going to stay at $5,000? What do you think?
No,
but they're really cheap at the start, right? But it's the average over the lifetime of the asset, which is what you need to think about. So
it's the projected body corporate fees that I love.
Yeah, right.
They're not even up and running yet.
Right. Yes, and they do a big spreadsheet.
Here's what we estimate the body corporate fees are going to be.
Yeah, and so this comes back to your point about understanding investments. It's like there's some, you don't want to learn that lesson the wrong way. Seek out a mentor or someone who's been there who can tell you these things about how it works. And then when you're doing your maths on cash flow, You want to look at the rent and minus, the true economic costs of running it, even if they're not outgoings that you'd have to pay tomorrow.
Yeah.
Because otherwise,
over time, you do have to put a new roof on, repaint the outside.
Same with interest rates.
Yeah.
You got to look at your interest rate and you build a margin, and you say, well, if the interest rates are 4% now, what if it averages 5.5% over the next 20 years, or if you were buying in 21?
I mean, the banks do that. The banks have their, what do they call it, a stress rate?
True, but I think you don't. I mean, you wouldn't want to rely on that, would you? I mean, you want.
No, but a lot of the time, investors think that this stress rate that the banks are using, it's such a pain.
Right.
They won't lend me the money because how ridiculous they're using 7% interest rate when we're only paying 4%. Well, we've seen over the last few years, haven't we? Interest rates went from 2.5 to 7.25 or something. So these things can happen. And the rule I personally use for finance is if a main bank won't lend me the money, it's too risky.
Yeah, I that's a great point. I remember that as so what I used to say back in the day was the bank won't lend you the money, you probably shouldn't be borrowing.
Yes.
So same thing.
Yeah.
And so so that's how for me that's how I'd be thinking about cash flows, trying to think about the true economics, the hidden costs, and making sure that there was a decent margin to cover all eventualities. And and then if you're buying another property, how is that going to impact your cash flow overall? You want net, eventually you want ideally a surplus every year to be in a growing surplus as you're adding properties and thinking about your portfolio purely because the capital gain will take care of itself. In fact, 100%. The capital gain and the cash flow are completely interlinked.
Yes,
because it's the rental growth over time for a leveraged asset, and then the yield that an investor would buy it on, right, based on the current cost of capital. That's what makes the appreciation of the value of the
you get peaks and troughs, don't you? Because you get
people
varying
bid it up and down.
Cap rates when everyone's feeling positive because the whole market is roaring.
Well, the cost of capital changes.
Rents are high, capital costs are low, margins are big. There's no risk, and then people are willing to not only are rents high, but yields are low. And so,
exactly,
and then you get margin, then you get compression of yields or cap rates, and rents come down. So then prices double down.
But I guess my point is, if you just keep it simple, right, and you just focus on growing a portfolio of cash flow positive properties over a long period of time, the capital gain will take care of itself, right? And
back to our previous point about managing risks, some surplus cash flow will help you handle every risk.
You're playing defense, not offense, because all of a sudden, if something happens, you've got that buffer there to make sense. And then the last point is you don't need to shoot the lights out, and but if you do that, you probably will. You probably outperform the people that are trying to shoot the lights out.
Slow and steady.
And that's the irony of all.
Can you actually buy residential real estate which pays for itself on day one, assuming that you're borrowing every cent?
No, I don't. Well, you'd be more likely to today than you would have 3 years ago. And it may, there'll be situations that come up where that might be possible through clever enough, searching, looking, and finding. But I think if you were to ask me on average, I'd say even today, because, we've talked a lot about rates and insurance.
Yeah.
But you look at if you can buy today on a 7% gross yield, is that the same 7% gross yield as it was, 5 years ago?
No.
Because your net yield is going to be actually really affected by that
3.5.
significant increase in rates insurance. Again, it's an example where you've got to be careful. The gross yield may not be quite as good as it sounds.
It's still a good guide, a good barometer to compare one with another, but it's not. It's not a true indicator of what you're actually
going to get left over.
So I think that you can buy properties today that will pay for themselves from day one. They are hard to find.
That's my point.
A lot of the time, you will have to manufacture some improvement by doing a renovation, putting another house on the back, or subdividing, or turning a basement into a one-bedroom flat, or just all these sorts of things. But it can be done, but it's difficult. And also, a lot of the time, people who, especially people who are just starting out in property investment, not only do they want a property where the numbers work well, but they also want it to be pretty. Well, that ain't happening. Those properties are too sought after by the owner-occupiers to get anywhere close to the numbers working. So typically they tend to be pretty brutish and sort of ugly properties. Tenants will happily live there. Owner-occupiers don't lose their minds over them.
So Wellington is an interesting example right now of a place that perhaps has slightly different risk profile to other cities. What do you think about Wellington as an investment location today, and what are the sort of risks that you would be thinking about specifically related to Wellington?
Yeah, I think if you take a long-term view, Wellington is a great place to invest right now. I mean, the cities generally are out of favour, and they have been since COVID. The regions or further out of town is more sought after for lifestyle reasons, gardens and all that sort of thing. So you are counter-cyclically investing, and indeed Tony Alexander has some great data which shows the relative position of the various locations around the country compared to where they normally track on a long-term basis relative against the whole country. And Wellington City and Auckland City, interestingly, are about the cheapest markets in the whole country. Obviously, Wellington is going through a lot of trouble at the moment, but that is why it is cheap.
Yeah, exactly.
That is why it is cheap.
Yeah.
So you have to take a long-term view. I'm not suggesting if you buy something today, you all of a sudden will have made a whole bunch of money in a year's time. Not necessarily the case. In fact, you're highly likely that you won't have. But at some point, the market will improve, and you will get handsomely rewarded.
How have some of the risks changed? In terms of like you've got healthy homes now. You've got it's hard to inflation has made renovating almost impossible to make money out of renovating, and the cost. So your properties that are dilapidated may be difficult to squeeze a return out of because it's too expensive to kind of do them up. You've got earthquake risks that are different for multi-flat properties, perhaps in Wellington. Talk us through some of those risks that are specific.
Yeah, I mean, earthquake. Insurance. That's an interesting one. I mean, everyone knows that insurance premiums have gone up and up and up and up since kind of Christchurch earthquake.
I mean, we're paying for the rebuild, right, to some degree.
That's right, and we're paying for all the strengthening that's need to be done. That of course is something else, but we're actually at a point now, as far as I can see, where insurance premiums are starting to come down, or they've plateaued, depending on where you are and what kind of property it is. But I spoke to someone just not long ago, and their body corporate levies, for example, they recently came down from 13,000 a year to 7. Well, that's a big change, and that's driven almost entirely by a reduction in insurance premiums. So I've told people for a long time that insurance premiums won't go up forever; they will come down at points. And everyone thinks I'm just being a typical bloody snake oil salesman, hot air spouting real estate agent, trying to shoehorn them into something they don't want to buy. But we're now seeing that insurance premiums in some instances, many instances, coming down now. So, but there's no question they're still very high. And bodies corporate, the levies on body corporates, obviously the older buildings, they're very high because it costs a lot of money to maintain these things. I think actually people have an overly negative view of body corporate because every building costs money to maintain, and with a good body corporate that is prudently managing their finances and determining what to spend their money on is a great asset because they're coordinating all that work for you, being sensible about it. And regardless of what building you own, whether you're in charge of the finances or a body corporate team, it's going to cost money. And at least with a body corporate, if it's well planned, it's smoothed out over time. So there's no nasty shocks.
So in other words, what we were talking about before about true economics, they tend to be more reflective of true economics than say a brand new building that hasn't had its time to settle and the time for the body corporate to get experience about what it needs and when it needs it.
And as long as it's being run by people who have good skills and are sensible in terms of managing money, So if a body corporate levy is too low, well, you'd worry that the building's not getting maintained. And there's actually big costs on the horizon.
False economy, right?
So you need to check out what are they spending their money on and the track record of where that money's been going, and do they have a buffer fund in there? Because you don't get that when you buy a villa. You don't get a bank account to pay for your future maintenance when you buy a villa. Whereas if you buy an apartment, I've got one for sale at the moment, and they've got $550,000 in the bank. Well, that's a huge asset.
Yeah. I would say for me, I think one of the biggest risks right now buying in Wellington is that you can't rent it.
Yes, yep.
And where the rental market,
you can rent it. It's just a question of how much for.
You know what I mean, though, right? Like they right now, you could overestimate how much you could rent it for, and you could have it sitting empty, chewing your cash flow quite easily, because the rental market is worse right now than probably the sale market at the moment.
The rental market is very poor, very poor. I mean, I think that the student end of the market will likely to improve early next year as students finally start coming out of the halls for the first time in reasonable numbers early next year. But
this is also the opportunity, right?
Yes,
the opportunity.
100% right. So if something is renting at the moment and it's renting in a depressed level of rental income, you are doing yourself an injustice to assume it's going to stay depressed forever.
Yeah.
You have to be able to survive while it's at that depressed level, but it won't stay there forever. So don't assume that. You've got to assume normalization of the revenue again, right?
Well, in the same way of thinking about the cost through time, you've got to think about the cash flow through time as well, not just the immediate way it looks.
Yeah. So no doubt about it, you have to be able to survive this period of poor rental returns. But is that a year? Is it 2 years? Is it 6 months? Is it they will come back.
Adam, amazing chat.
Yeah,
and I just want to
you.
say how much I appreciate, you've been being vulnerable, talking to us about your mistakes so we can learn from, what you've been through. And it's really appreciate it.
My pleasure. We're all fallible, aren't we?
Exactly.
Yeah.
Hey, thanks for tuning in. That was the Lowe Down and can't wait to do it again. Please like and subscribe and we will see you next week.
See you next time.